So I am incredibly excited to share this very video with all of you because I just got this email from a rather newer investor asking all about which stocks to focus on for passive income in order to build an incredibly reliable dividend portfolio. But first, I want to go ahead and introduce you to Nala and share, at least generally speaking, what even makes a stock worth your attention or a buy. So, are you ready? Whew. This is Nala. She's a puppy and keeps knocking over all of my lights. So she's going to go ahead and talk about some of our quality stocks with us. So when it comes down to whether or not a company is a buy or not, you got to look into whether or not it's reputable. And moreover, if their product is playing an important role in our everyday lives. I mean, think about it. In your everyday life, what are you doing or using continuously? Or seeing others using or doing continuously? And most likely it all comes down or backtrack to some of these big name companies. I mean, you're probably watching this on an iPhone, maybe sipping on a Starbucks coffee, a soda, eating a Big Mac, snacking on Doritos, or even just thinking about your current healthcare coverage plan. Okay, maybe not. Either way, I say don't just spend money with these companies, become an owner of them. And if you're a fan of certain companies or are buying their products often, chances are you're not alone. This then clues us in to how popular a company really is or may become. But there's more to it, of course. It all comes down to a company's balance sheet and management team. In other words, are these companies well run? Are they producing revenue? Or are they carrying debt? Now, usually a clean balance sheet tells us a whole heck of a lot about how an executive team is running the company and whether or not they're actually effective in doing so. But there you have it. Some Buffett-proof pieces of criteria that you can use to get started, which is exactly how I got started in picking stocks and managed to grow my portfolio from 5 figures all the way up to $173,000 plus. And right now with this current environment, a lot of companies are being impacted, which is why you got to pay attention because there's opportunities right now. We're going to go ahead and jump to the 7 dividend stocks that I have for you now. All great opportunities for passive income, with the very first stock being Union Pacific, ticker symbol UNP, which is a freight hauling railroad operator operating over 8,300 locomotives across a stretch of over 32,000 miles within the United States. Now, I want you to go ahead and think about supply and demand with Union Pacific, as well as the cost of shipping rising, all while their clients are cutting back on spending. And then we have a no-brainer there as to why the stock share price has sunken down by over 8% year to date, trading for just $222 per share. And to really grasp the power of Union Pacific, zoom out with me for a moment to see over 178% worth of share price appreciation over the last decade. Analysts are looking into the future to see 21% worth of upside, coming up to $269.69 per share, all while smart money has been making their money moves last quarter already, scoring more than 130,000 shares. Now, of course, we're here for the dividends, and Simply Safe Dividends rates Union Pacific very safe, with the dividend yield coming in at 2.34%. It's been on a dividend streak now for the last 25 years, all while growing steadily here by an average of 16% year over year. Next up, a very interesting opportunity in my opinion, considering we're on the brink of World War III, and we actually may see a Republican back in the White House. So let's just go ahead and talk Northrop Grumman, ticker symbol NOC, a company that's not quite my Lockheed Martin, as you know if you've been following the channel, but equally as powerful, with a focus in space, aeronautics, defense, and cyberspace to meet the ever-evolving defense needs of our good old Uncle Sam and allied forces. So when I see it down by over 8% on the year, trading for $425 per share, that's down from a peak back in April of $485 per share, I'm in, especially after realizing that they just struck a $244 million deal with the Navy, a $119 million deal with the Army, and opportunities galore probably moving into the future. Now check this out. If we click into their 10-year chart, we see appreciation of over 316% over the last decade, and that's not all. Analysts foresee more upside coming, forecasting 18% worth of upside, climbing up to $504.11 per share. But as always, we're the dividend investors looking for that dividend to enjoy. We get a 1.94% dividend yield. That's been on a dividend streak for the last 34 years, all while growing by an average of 12% year over year for the last 20 years. But if you're really looking for a war-torn stock opportunity, you can actually find it in an entirely different sector with Hormel Foods, ticker symbol HRL, as this company has just been battered in the red all year long. Talking about a stock share price coming in at a mere $30 per share, PE ratio at 21.7, yet zoom out to the 10-year to see over 53% worth of appreciation coming in with Hormel, and that's in comparison to other stock opportunities. Well, it's not that much, but when we we see that hedge funds have been pouring a lot of money into Hormel Foods, scooping up nearly 40,000 shares of this company last quarter, while analysts just continue to predict upside, with a share price hitting $32 per share in due time. However, the magic with Hormel Foods and why it made today's list is actually when it comes to the dividend. It comes in at a 3.72% dividend yield. It's been on a streak for the last 58 years, so talk about reliability, all while growing quite impressively still by roughly 12% year over year for the last 20 years. Now, investors, ultimately, I am not here selling any of you a course or proclaiming to be some market wizard or stock guru. I'm solely here doing this for fun and just enjoy being on this financial freedom journey with all of you. So before I jump into the next stock opportunity, I actually want to invite you to tap on that subscribe button to join me on this journey. You see, not long ago, we were at roughly 80% of you not subscribed, though watching my content, and now we're at 75%. And my goal, my personal goal, is 50%. So I'm going to need all the help that I can get, if I'm being honest. And while you're at it, I want you to go ahead and also let me know that this video is of value to you by tapping on that thumbs up button. That just lets me know to keep creating content just like this. With that, we're going to kick back into gear with a beverage behemoth and a salty snack king. We have Pepsi, ticker symbol PEP, which, given the continued challenges in sales growth and just volume declining, it just hasn't really managed to escape the wrath of shifting consumer trends. So here we are right now with the stock down in the red still after falling from that peak of $181 per share, trading now for $166 per share. But zoom out, we're going to see nothing short of reliability with Pepsi, coming in at 152% worth of share price appreciation over the last decade. And plenty of optimism continues to stem from the analysts as we speak, with over 12% worth of upside expected for the share price to hit $186 per share, all while hedge funds just continue to pour money into Pepsi. Last quarter, they scored more than 149,000 shares worth of the company. Now, if you're asking why, well, security and reliability should be your guides, which is exactly what Pepsi delivers on, with a nice chunk of a dividend coming in at a dividend yield of 3.26%, all while it has been paying dividends out for the last 59 years and growing that dividend by about 11% year over year for the last 20 years. But if such an iconic name like Pepsi isn't quite right for your portfolio, perhaps McDonald's, ticker symbol MCD, will be. While I know McDonald's, along with all the other restaurant businesses out there right now, are struggling, it's actually McDonald's that I have the most conviction in, just given how iconic McDonald's actually is. No, not just their Happy Meals, but I'm also just really excited about their business model because it entails real estate operations and leasing out the vast majority of their properties to their franchisees. In short, an investment into McDonald's isn't just about a Happy Meal and Big Macs. So as I see it slumped down to a measly $250 PE ratio at 21.3, which is quite low for our friend Ronald McDonald, if he is even still around. Really haven't seen him lately. But should the McDonald's value menu help correct their stock along with interest rate cuts for real estate opportunities, I think we have a real winner coming in green in no time. After all, over the last decade, we see 220% worth of share price appreciation, even more upside expected by the top analyst out there, with a projected share price hitting $308.28, which would work out to about 22% worth of upside. Something I personally am still loving. And until then, shareholders would reap the benefit of their 2.66% dividend yield that's been paid out now for the last 47 years without interruption, all while growing by an average of 15% year over year. Now, on the other hand, if an investment into Big Macs won't feed your dividend appetite, you can splurge on Starbucks, ticker symbol SBUX, which is often not recognized for being the second largest fast dining chain in the United States by sales, and it just continues to grow its global footprint, something I like to see. But as these grande mocha choca lattes cost an arm and a leg and are seen as a luxury expense, the company is struggling in our current economic environment, whereas the stock right now is down by a whopping 15+%, trading for just $80 per share, making for one heck of a buy right now. But if we go to about a decade out, we see over 150% worth of growth and share price appreciation there. So ask yourself, in the next 3 years, 5 years, 10 years out, will these sugary spiked coffees still be around? I think so, and I also think the analysts think so, calling for more than 10% worth of upside for the share price to hit $80 $88.82 per share. But until then, a cool 2.84% dividend yield. It's been on a streak for the last 13 years now, while growing by about 17% year over year. And then we have United Health, ticker symbol UNH. That is back to some lower lows in the red again, trading for $481 per share. That's down on the year here by about 8%, but don't panic. Zoom out with me. We see United Health delivered on over 585+% worth of appreciation. And based on how insurance is in the United States, well, I'm really just doubtful that United Health, the biggest player in the game, way too big to fail, will disappear. However, during election years like we're in right now, we tend to see more volatility in stocks like United Health, given policies are up for debate right now and very well may change. Either way, analysts forecast over 18% worth of upside, with the target share price climbing up to $567.69 per share, all while smart money has been scoring over 777,000 shares last quarter of United Health. And until the coast is clear and we're able to just enjoy United Health for what it is, well, you can collect on the dividends for a 1.75% dividend yield. Been on a streak for the last 31 years now and counting, and it's way outpacing other dividend stocks that I mentioned, with a 41% year-over-year growth rate for the last 20 years. So talk about a real dividend growth gem. There you have it with United Health, but then you also have the 6 others mentioned. I want you to go ahead and comment down below on which dividend stocks you own, which ones that you're interested in owning if you don't own them already, or if you have better dividend stocks in mind. Be sure you're also subscribed to the channel to never miss another dividend stock idea. I'll alley-hoop you right now and just go ahead and tell you to click right here for more insights now.